All right, so why is the acquisition cap rate so important when purchasing an oceanfront hotel? Well, guys, the acquisition cap rate is also known as the capitalization rate. That's the rate at which capital is being injected into the investment, is one of the most crucial metrics when buying an oceanfront hotel because it helps investors determine the potential return on investment before financing. Again, I'm going to highlight that, before financing. Now, there's some other factors that come into play, and here's why it matters so much. It measures profitability and risk. Now, the higher the cap rate, let's use an example of like 8 to 12%, the higher the return. But typically higher risk. Now, older properties, seasonal fluctuations, and higher management complexity could be the reasons for having such a higher risk, which is also the reasons why you have a higher return. You don't really want to take that risk unless the reward is there. Now, a lower cap rate, let's say 5 to 7%, means a more stable investment, but a lower immediate return. Essentially, guys, if you're going to take all that risk, you want to make sure that you're going to get paid for it. Now, an example would be if a hotel generates $500,000 per year in net operating income and costs $5 million, well, the cap rate is 10%. Again, that's $500,000 in net operating income divided by the $5 million initial investment or purchase price. And I know you're probably wondering, well, how do I know what my net operating income is? Well, guys, it's really simple and really, really easy. In the example I'm going to use a potential rental income of $5 million. And essentially, in order to arrive at that number, you take this total square footage of the commercial property and you multiply it by the rent per square foot. So just in a hypothetical example, if you have 10,000 square feet, you're multiplying that by $17 a square foot. That's going to give you your potential rental income. Now, you do have to factor out next your vacancy and credit losses. Now, in our example here, it was a 50% vacancy. So basically, half of that $5 million, $2.5 million, is attributed to vacancy and credit losses. If you subtract that from the potential rental income, it is going to leave you with the effective rental income. Now, from there, you have to factor in other income, collectible. So, in other words, let's say that you had a parking lot associated with this property and you made $45 per parking lot space every single month, or you had a billboard on the side of your business that you got paid rent for. That's where you would add that in. You would add that into the other income. Now from there, once you add the other income to the effective rental income, that's going to leave you with the gross operating income. And from the gross operating income, you know the factors of your business. You know, for example, that your business has 40% operating expenses. So you're going to take 40% of the gross operating income, and that's going to count for your operating expenses. Those operating expenses are your utility bills and your everything it takes to run the day-to-day activities of your business. You subtract that from the gross operating income and you are left with the net operating income. And in our instance, after factoring in for operating expenses, we are left with $1.5 million in net operating income. And that's how you arrive at net operating income. Now, the second thing is it's going to help you compare different investment opportunities. And this is really where the power of the cap rate comes into play for most investors. Cap rates allow investors to compare multiple hotels, like a hotel versus another hotel, or even real estate assets, like an oceanfront condo versus a hotel, or perhaps a long-term rental versus a hotel. And it helps you to decide where it's best for you to deploy your capital. Again, capitalization rate is another way to say cap rate, and it's the capital going into the investment. Now, Myrtle Beach Oceanfront condos, let's say that they have a cap rate of 8 to 12, Myrtle Beach Oceanfront hotels, let's say that they have a cap rate of 8 to 12%. Now, if you're comparing where to put your money, and you're looking possibly at oceanfront condos, which is a short-term vacation rental property in our market, well, they could have a cap rate of 3 to 6%. And then even further compared with long-term rentals that have a cap rate of 2 to 4%. If you want higher returns, hotels can be better than condos, but require active management. So you're taking more risk, so you want to make sure that you get more reward. Now, number 3 is that cap rates can help you indicate market trends and even valuation. Now, cap rates do fluctuate based on market conditions. This is very important to investors wanting to make sure that they're putting their money in the right place and at the right time. All right, so if cap rates increase, this could be a signal that hotel prices are declining. Now, it also could indicate that that the property is undervalued. It's certainly plausible that that could be going on. Now, is that always the case? No, because, sellers obviously want to make as much money as possible when they're selling a property. But you can find deals that way. Now, if a cap rate decreases, well, hotels are getting more expensive, which could indicate stronger demand. Now, if an oceanfront cap rate rose from 8 to 10%, it may signal increased risk, e.g., tourism downturn, could be higher supply going on in the market, or it could be a buying opportunity. Now, number 4, a cap rate affects your financing and your loan approval. Now, lenders use cap rates to determine stability and risk level when issuing loans. Higher cap rates generally mean that lenders may see the property as risky and require a higher down payment, as where with a lower cap rate, the lenders are going to, possibly have some more financing options available to you, but that could mean lower return on investment. Now, banks prefer properties with consistent net operating income and stable cap rates for better loan terms. Obviously, guys, if the cap rate, a financing metric, is showing that the property is not very stable or that the net operating income is all over the place, then it's going to be a little bit more risky for the bank to be your partner in that deal. And obviously, they're going to want a little bit more money. So essentially, pay attention to this metric because it could be determining how much your financing costs you. Now, cap rates are also going to help investors set their exit strategy. If you plan to sell a hotel in the future, the cap rate affects how much you can sell it for, ultimately. Now, if the market cap rates fall, your hotel value is going to increase. So when that cap rate goes down, the value goes up. If cap rates rise, your hotel's resale price drops unless your net operating income grows. It's an important little caveat there. Now, an example, let's say that you buy a hotel for $10 million at an 8% cap rate with $800,000 in net operating income. If cap rates drop to 6%, the same $800,000 in net operating income would value the hotel at $13.3 million. That is a big equity gain. Hey guys, now here's our final takeaway. The acquisition cap rate is crucial. And that's because it dictates your initial return, your risk level, your financing options, and even your future resale value. So smart investors use it as a benchmark to be able to compare deals, assess risk, and maximize profits when purchasing oceanfront hotels. Now, you always want to analyze cap rates in the context of market trends, hotel management efficiency, and also long-term value appreciation.